Hello, this is Craig Mitchell, your personal mortgage consultant for life. And this video that you're going to watch today is an excerpt from one of my first-time homebuyer seminars. So if you're a first-time homebuyer, this is information you definitely need to know. And even if you're not a first-time homebuyer, I can almost guarantee that most of the information will be new to you, so you can definitely benefit by watching it. If you do have any questions or comments after watching the video, please email me or call me, and my contact information will be provided at the end of the video. Okay, so today I'm going to show you how to figure out the maximum purchase price of a home that you can qualify to buy. Now, what you think you can afford and what the bank will qualify you for are usually different. So here's how the bank determines what you can qualify for. The banks use what are called debt to income ratios, which is basically how much debt you have compared to your income. And the easiest way to explain this is just to show you an example. So here it goes. So first of all, the banks will allow you to have a monthly mortgage payment from 30 to 45% of your gross income before taxes, and up to 55% for your house payment plus any debts that show on your credit report. Now, the numbers I'm going to go over with you here are for an FHA loan, which is your typical first-time homebuyer loan. If you're not doing an FHA loan, the numbers are actually worse. So FHA is going to get you the most house for your money. So for this example, let's say your income is $5,000 per month before taxes. Well, 30% of $5,000 is $1,500 per month, and 45% of $5,000 is $2,250 per month. So based on the numbers I just went over, you would be able to qualify to buy a home with a monthly payment somewhere between $1,500 to $2,250 per month. Now, I know that's a wide range, but the exact amount depends on how much other debt you have. So if you have a lot of other debts, such as credit cards and car payments, you're going to be on the lower end. But if you don't have very much debt, then you're going to be on the higher end. If you don't know how to figure out percentages so you can calculate this on your income, what you do is you simply multiply your monthly income before taxes by 0.3 and by 0.45. So for this example, it was $5,000 times 0.3 and $5,000 times 0.45. And now that you know how to figure out what monthly payment you can qualify for, the last thing to go over is what price home you can buy to correspond to the monthly payment. And I'm sure you're aware that interest rates do change every day, so the formula I'm going to show you today is just a rough estimate, but at least it'll give you a really good idea. As a basic rule of thumb, for every $100,000 you borrow, your monthly payment will be about $750 per month, which includes your property taxes and insurance. Now, obviously, when interest rates go up, this number would be a little higher, and when they go down, it would be a little lower. So to figure out what price home you can buy, you simply take the monthly payment you can qualify for, which we figured out just a minute ago, and you divide that by 750. Then you multiply times 100,000. Now, before you start freaking out, I know this might sound a little complicated, so let's go over a few examples, and once you see a few examples, you'll see how really easy this is to figure out. So for this example, if you want a monthly mortgage payment of $2,000 per month, what you would do is you'd simply take $2,000 divided by 750, which equals 2.67. Then you take that 2.67 times 100,000, which is 267,000. So if you were to buy a $267,000 house, your payment would be about $2,000 per month. Now let's do two more examples. One at $1,500 per month and another final example at $1,000 per month. So for our second example, if you want a monthly mortgage payment of $1,500 per month, you would divide 1,500 divided by 750, which equals 2. And then 2 times 100,000 equals 200,000. So on a $200,000 house, your payment would be roughly $1,500 per month. For our final example, let's say you want to have a monthly mortgage payment of $1,000 per month. So you take 1,000 divided by 750, which is 1.33, and 1.33 times 100,000 is 133,000. So a $133,000 house would have a monthly mortgage payment of about $1,000 per month. Again, remember, these are just estimates, since obviously I don't know what interest rate you're going to qualify for. If you'd like to know exact figures, just shoot me an email or give me a call. Let me know what monthly payment that you can afford, and I'll let you know exactly what price home you can look at based on today's interest rates. Oh, and one thing I want to caution you on a lot of internet sites that have houses listed for sale, it shows you what the estimated mortgage payment is. And a lot of these sites are very deceptive. Most of them assume that you're putting down 20% and their payments do not include taxes and insurance. So for example, you might see a house listed for $200,000 and it might say that you can buy that $200,000 house for only $800 per month. But what they're not telling you is that's based on you putting $40,000 down for the down payment, and that does not include your taxes and insurance, which would be over $300 per month. The examples I'm going over with you are assuming you're putting little to no money down, and they're assuming that the taxes and insurance are included in the monthly mortgage payment. If you do buy a $200,000 house with no money down and you do include your taxes and insurance, the payment is about $1,500 per month. So keep that in mind when you're on the internet. There are a lot of companies out there that use deceptive advertising. So anyway, I hope this helps. It's not exact science, but it will get you darn close.